Good morning. It's Market Day Report. We're up and trading. You know, we had a pretty nice rally yesterday with, I think, every row crop positive. Yeah, every row crop was in positive territory yesterday, including this one, canola. We're moving higher now for the third straight session. Canola market up over 24% year to date. Again, higher across the board. This one higher for 4 straight sessions. The oats market. The week has been crazy for oats with gains of over 30% year to date, up 12%. And how about this one? Gains of over 35% year to date. Rough rice in that November contract up 29.5, 1392.5. We're working our way kind of backwards from what I normally do, but here's the cotton market back up above 80 cents at 80.18. That's up 1.88. Let's go to the wheat market and soft red, Chicago, down 3/4 of a penny. Most active September at 6.13 1/4. Hard red, September, 4 lower, 6.45 3/4. You know, we started with canola, and at least bean oil have been moving in tandem. November beans right now, though, down 3 cents at 11.98. I mentioned the bean complex. Here's soy meal, mostly lower. Bean oil, mostly higher. There's that tie back over to canola. And finally, to the corn market, which is lower, down a penny 3/4. 4.56. All right, I've thrown out a lot of numbers there. What do we do with it? Well, I turn this way and I talked to Chris Swift, Swift Trading. Chris, lots of numbers in there following a pretty nice widespread rally yesterday.
It did, and it kind of came out of the blue. Not many people left on Thursday with the expectation of 50-cent beans higher on Monday morning. But what it does point out is what we need to be doing. And we talked over the last couple of weeks when we looked at the low prices in corn and soybean meal and said, you know what, it'd be nice to kind of put some of this away. And now we see for reasons why. We don't really know why, but I took a minute this morning to look, and July of 28 corn is 503. 60 cents higher than where it is right now. And a call option at the money, $5, would be about 38 cents, right at about 7% of the value of that contract. Go out another dollar, $6.14. A procurer, somebody that needs that inventory for 14 cents for a year and a half, can go out and lock that in for 14 cents at $6. If he wants to spend 38 cents, he can lock it in at $5. Now you're at par with it. The market goes down 38 cents, you're at a wash. It goes down even more, you're made whole again. If it goes up a bond 538, you're fixed. You don't ever have to pay another penny higher for your feed costs. And we're talking a year and a half out, not just the next year out into July of this year. No, I guess 2 years out. 2 years out to July of 08. So interestingly enough, how we were able to fix some of these products for a very inexpensive price. And then when that day comes, regardless of where it is, we already know what we're going to be. So looking at that, and especially we heard our poultry, and it's going to overtake pork. Both pork and poultry are huge users of soybean meal. So where were we? $300. Now we're trading $311. Next stop, maybe $330, $340. Where do we want to start fixing those prices deep out into the future for today, that sometime out in the future we're going to be able to use them?
So in other words, sure, today is important, but looking down the road and trying to have a plan, you can do that right now.
Oh, absolutely, and that's what we're trying to do. We're trying to fix some things. We've seen some enormous price gains in cattle. Hogs have slipped off quite a bit. We've seen some pretty good declines in beans and corn and wheat. But now we're starting to come back up again, and those lower prices are very beneficial to those that need to procure inventory, and, of course, to the higher prices to the cattle and hogs. We need to do something to market that in order to capture that higher price.
All right, so you mentioned a lot of livestock there, so that means one thing. And I think you know what it means.
Next.
We're going to take a break. We're coming back and talking livestock with Chris Swift. This is Market Day Report. Let's talk livestock. We'll start live cattle or fat cattle. That's where we start. And Right now, we're in the red, down $1.12, 237.97 on the October, $1.07 lower, 233.57. And look, everything there in that 233, even 234 in February, but we're trading a 235 out in the April contract. So again, kind of interesting to see the 233s up to 234 and then 235 as we work our way out. Do we see that same kind of trend with the feeders? And the answer is no. We see a discount for every month. August, $360.50. That's unchanged. September's at $357, then $353 on October, $350 on November, $344 on January. Kind of interesting how feeders and fats aren't trading the same in those deferred markets. What's that tell us? Well, we'll ask him. Chris Swift, Swift Trading. What's that mean?
It's all about the basis right now, and the expectation of what we are now unable to move the beef at the center of the plate to the same extent as where we were. We have exceptional beef production for the number of animals that we have, and it's just congesting a little bit. And so we can't pay as high a price for the feeder cattle as what we should be able to. And we're just showing a lot of negative margins projected out there for feeding cattle. Same thing we talked about in corn, where we see that a little bit higher price, trading $5 corn a year now. Now we're trading prices $10, $20, $30 under where it is right now. And again, that's expectation. So if you don't want to pay any lower price than that, you can still fix that price. You do not have to fix the basis. That's a very interesting point, because people think, well, if I'm locked in there, I can't gain anything back. And that is true if you sell the futures or you sell a call against what your put position be. But if you just own the put option, you have every ability to converge the basis if it converges with cash still higher. If it doesn't, there's nothing you can do about that. And that's the bad thing about letting basis get too far away from us out there, or could be advantageous to some. But right now for our producers, it's a really bad situation. I'm buying at the highest price today, and I've only got big discounts to market into the future.
Okay, and we've talked about this, the negative margins on the packer side. Right now, feeders are right there as well, aren't they? I mean,
they're dropping. So we went from $300 a head profit 3 weeks ago, $200. Last week was $100 a head profit. If we lose another $2 or $3 in the cash market, and remember that every feeder steer placed from January 3rd or 4th is higher. So we're going to have to bleed in a lot of higher, more expensive inventory into those calculations. And then if we don't get the higher fat cattle prices, that will turn them negative pretty quick.
Okay, so now I'm also kind of wondering here, the whole feeding industry has changed, at least in those areas where they're bringing in the beef on dairy cross, because we're feeding those out more than 180 days.
Absolutely. A lot of them go on as calves, bottle-fed calves. They'll go on feed there. And it has changed dramatically. So interesting. It's a 6-year-long bull market. That's very interesting. All of the economics that we think that generally will increase supplies, will entice somebody to do something, has not. We have just not seen the cow-calf producer be able to increase production at a rate really needed. So we have changed a lot, and we have gone from feeding animals on a very strict rotation to the longer we keep them on feed, the better off we're going to be.
It's not like the gold rush where everybody started panning for gold. You just can't afford to jump in to the cattle market and try to cash in with these high prices. Right now. And that's the unique thing.
And we hear a lot of Johnny-come-latelys. We hear, price of beef is so high and nobody's going to do it. We already know all that. We already know there's a huge shortage of cattle. And what has the industry done over the last 2 years? They have worked methodically to keep enough beef out there so prices didn't go high where the consumer couldn't afford it. Consumers can still afford it right now. And the boxes, and of course, clearly with the dairy beef, without it, there's no telling what would happen.
Love having him in here. Always a wealth of information. Chris Swift, Swift Trading.
Obviously a lot that you're following. So hopefully, Chris, you enjoyed that 3-day break over the weekend from the markets for 4th of July.
A blackberry cobbler last night.
There you go.
So,
I'd love to hear it.